You see, money is not just pieces of paper or numbers in an account. It's a claim on goods and services. When that claim weakens, when you can no longer buy the same things with the same amount of currency, you lose real wealth. That's inflation. And while inflation itself is not inherently bad, after all, economies naturally grow and change, its implications on cash are profound. If the supply of money increases faster than the supply of real goods and services, then the value of each unit of money declines. That's what we're seeing. People often make the mistake of thinking that holding cash is being conservative. But in this environment, it's actually one of the riskiest things you can do. Think of it this way. If inflation is running at 4% and you're earning 0.5% on your savings, you're effectively losing 3.5% a year in real terms. Stretch that over a decade or two, and the compounding effect becomes alarming. You're not just standing still. You're moving backward. Cash, what was once considered the safest asset, the ultimate store of value, the universal medium of exchange, is now quietly eroding in value right in front of us. Most people don't notice it. It's slow, insidious, and largely invisible if you're not paying attention. But over time, it eats away at purchasing power in a way that can be devastating if you don't act accordingly. When more money is chasing the same or fewer goods, prices rise. That's the basic principle. And while wages may increase in nominal terms, they rarely keep up with the real cost of living. So people feel squeezed. They're earning more on paper, but can afford less. That's the erosion I'm talking about. It's like a silent tax on your wealth. Ladies and gentlemen, throughout history, we've witnessed the rise and fall of empires, the ebb and flow of economies, and the transformation of financial paradigms. Today, we stand at a pivotal juncture, prompting us to question, can we still rely on cash as a currency? Traditionally, cash has been perceived as a safe haven, a secure repository of value. Yet, as we delve deeper into the mechanics of our modern financial system, it becomes evident that this perception warrants reevaluation. Now, this isn't theoretical, it's happening. If you look at the historical performance of cash, what it could buy you in 1970, 1990, 2010, and now, you'll see a very clear downward trajectory in its real purchasing power. In the last few years especially, the pace has accelerated. Central banks around the world responding to economic downturns, crises, and now a massive shift in fiscal policy have printed unprecedented amounts of money. At the same time, real productivity gains haven't kept pace, which has led to distortions in value. There's also a behavioral bias at play here. Humans tend to overvalue what they can see and control, and cash feels tangible and safe, but that safety is an illusion. The greatest risks are often the ones you don't see because they operate slowly and quietly beneath the surface. And the erosion of purchasing power is exactly that kind of risk. It doesn't make headlines every day, but it destroys wealth just the same. Low interest rates are often misunderstood. To many people, they seem like a gift. Borrowing is cheap, credit is flowing, and on the surface, it feels like the economy is being supported. But dig deeper and you'll see that prolonged periods of low interest rates fundamentally distort the way capital is allocated, the way risks are priced, and ultimately how wealth is preserved or lost. This isn't a doom and gloom narrative. It's about understanding the environment you're operating in and adapting accordingly. The rules of the game change. The relationships between money, credit, and real wealth are dynamic. If you're stuck playing by the old rules, you lose. So it's important to constantly reevaluate where you're storing your wealth and whether it's truly serving your long-term goals. We're in a period now where monetary and fiscal policies are more coordinated than ever before. Governments are running massive deficits and funding them through the creation of new money. That dynamic cannot persist indefinitely without consequences. And one of the most immediate consequences is the debasement of currency. Throughout history, we've seen this story unfold again and again. In every major economic shift, from the Roman Empire to Weimar Germany, from the stagflation of the 1978 to the more recent monetary expansions following the 2008 financial crisis, those who clung to cash watched their savings deteriorate. Meanwhile, those who understood the mechanics of monetary policy and inflation protected themselves by holding assets that adjust with or outpace inflation. Things like real estate, commodities, inflation-like bonds, and well-chosen equities. So when you think about your portfolio, your savings, your financial future, you need to start thinking differently about cash, not as a safe place, but as a potentially dangerous one if held too long and in too large a quantity. Cash has a role, yes, for liquidity, for short-term needs, but beyond that, it's a melting ice cube. The erosion of purchasing power isn't coming. It's already here. The question is whether you're prepared for what that means and what you're going to do about it. Because in the world we're heading into, understanding and responding to that erosion is not optional. Interest rates are the price of money, just like the price of anything. When it's artificially lowered and held there, it leads to imbalances. When interest rates are near zero or even negative in real terms, the incentive to save evaporates. Holding cash becomes costly. You earn nothing, and in real terms, you're losing value because inflation keeps ticking away, slowly eroding your purchasing power. So naturally, investors are forced to look elsewhere. They take on more risk. They reach for yield. This is exactly what policymakers expect. By making it unattractive to sit on cash or low-risk assets, they try to push people into the markets, into equities, real estate, corporate bonds, startups, anywhere capital might stimulate growth or create jobs. But there's a consequence. Asset prices become detached from their fundamentals. When the cost of capital is near zero, almost anything can be justified. Projects that wouldn't make sense in a normal rate environment suddenly look appealing. Zombie companies stay alive longer than they should. Speculation replaces prudence. And here's the issue. This doesn't just affect institutions or investors with large portfolios. It affects everyone. Pensions depend on fixed income yields to meet their obligations. Retirees rely on interest income from savings. When those yields vanish, those models break down. People are forced to take on more risk than they're comfortable with just to preserve their purchasing power. That's not a position you want the average saver in, and yet that's exactly what has happened. There's also a deeper philosophical issue. When the returns on capital are suppressed and the rewards of prudent saving disappear, it changes behavior. It shifts incentives. It encourages short-termism. It penalizes discipline. You end up rewarding debt over equity, consumption over savings, speculation over investment. And when those behaviors become entrenched, you don't just have a monetary problem, you have a societal one. Now consider the broader implications. When interest rates are held down for extended periods, it removes one of the most important signals in the economy. Interest rates are not just about borrowing and saving. They reflect time preferences, risk, opportunity costs. They're the mechanism that helps coordinate behavior across millions of participants. Without that mechanism functioning properly, you get misallocations, bubbles, crashes. So what does this mean for investors? It means you cannot rely on traditional safe assets the way you once did. Government bonds, cash equivalents, these are no longer sources of meaningful yield. They may still serve a role in liquidity or risk management, but they're not wealth preservation tools in this environment. You have to think differently. You have to think in terms of real returns, not nominal. You have to consider inflation, currency debasement, and policy shifts that could radically change the landscape overnight. At the sovereign level, low rates enable massive borrowing. Governments are emboldened to run large deficits because financing costs are minimal. And in the short run, that may seem like a benefit. Stimulus programs, infrastructure investments, social support. But over time, the debt burden grows and the options narrow. Raise rates and you risk collapsing the entire debt structure. Keep rates low and you continue distorting the system while undermining the value of money. It's a trap, and once you're in it, it's incredibly hard to get out without pain. Diversification becomes not just a strategy, but a necessity. Across asset classes, across geographies, across currencies. You need exposure to things that can't be printed. Real assets like commodities, infrastructure, productive equities, and even emerging stores of value that are gaining traction in a digital world. Holding these assets is not about chasing returns. It's about preserving purchasing power in a world where traditional tools no longer work as intended. We are living through an unprecedented monetary experiment. The rules that define prudent investment behavior for decades are being rewritten in real time. The signals that guided rational decision-making, interest rates being chief among them, are distorted or disabled. In such a world, simply relying on past assumptions is dangerous. Understanding the dynamics of low interest rates is not about theory. It's about survival. If you don't adapt, if you don't see the implications clearly, you risk being left behind. The landscape has changed. And in the absence of a reliable compass like interest rates, you have to be more deliberate, more aware, and more strategic than ever before. This affects more than just investors or banks. It affects the entire foundation of how economies function. Retirees who once depended on interest income now find themselves struggling to preserve purchasing power. Pension funds, once able to rely on government bonds for predictable returns, now take on more risk to meet their future obligations. Corporations, flush with cheap capital, may fund projects that offer weak real returns or buy back shares instead of investing in productivity. The market loses its anchor. Low interest rates may appear supportive on the surface. They make borrowing cheaper, encourage spending, and seem to boost economic activity. But underneath that surface is a complex system quietly being distorted. The price of money is being manipulated. When the cost of money is pushed down and kept there for a prolonged time, it changes everything from how people save to how companies invest to how risks are measured. Interest is the cost of capital. It reflects time, risk, and opportunity. When that cost approaches zero, people no longer think the same way about value. Savers are punished. They earn nothing for being disciplined. At the same time, borrowers are rewarded for taking on more debt. That shift creates a world in which risk-taking becomes normalized and often encouraged, while prudence is discouraged. Without a real cost of capital, you no longer have efficient pricing of assets. Markets disconnect from fundamentals. Investors chase returns wherever they can find them, often bidding up asset prices far beyond intrinsic value. This creates bubbles. It makes the system fragile. People think they are wealthier because the price of assets is rising, but those gains are not grounded in sustainable productivity. They are grounded in financial engineering and distorted incentives. When interest rates are artificially low, capital is no longer allocated to its most productive use. It flows where the terms are most favorable, not where the fundamentals are strongest. Unprofitable companies that should have failed long ago continue to survive because they can refinance debt cheaply. These companies are not driving innovation or efficiency. They are simply benefiting from an environment where discipline is optional. Governments also take advantage of this environment. Deficits become easier to fund. Large-scale stimulus programs become politically easier to justify. But that spending adds to national debt levels, which then become harder to manage in the future. If interest rates ever need to rise to control inflation or stabilize currency, the cost of servicing that debt becomes overwhelming. So policymakers become trapped. They are incentivized to keep rates low, even when that may no longer be the right move. Low interest rates also shift social behavior. People are encouraged to borrow, spend, and invest aggressively. The idea of saving for the future, once a pillar of financial security, becomes obsolete. The consequences of that shift are generational. Young people entering the workforce see an economy where traditional paths to wealth no longer function. Saving money feels like falling behind, so they are pushed into markets, often without the knowledge or experience to manage the risks they are taking. Most people think of diversification as a way to reduce risk, which is true, but not in the simplistic way it's often taught. Real diversification isn't just about spreading your money across a few different stocks or mixing bonds with equities. It's about understanding how different assets behave under different conditions and building a portfolio that can survive and thrive across a wide range of economic environments. That is the core idea. Markets are constantly shifting. Economies cycle through periods of expansion and contraction. Interest rates rise and fall. Inflation accelerates and then retreats. Political regimes change. New technologies disrupt old industries. These transitions don't follow a predictable path. They happen with uncertainty and often catch people off guard. If your portfolio is built for only one type of world, it will suffer in another. Diversification is the only tool that allows you to remain stable in an unstable world. It is a form of humility. It acknowledges that you do not know the future. No one does. Even the best investors with decades of experience get surprises. But if your assets are aligned in a way where the strengths of one offset the weaknesses of another, then you're positioned to weather the storm no matter where it comes from. This is not sustainable. A healthy economy requires interest rates that reflect real risk and reward. When rates are kept near zero for too long, the economy becomes addicted to cheap money, it becomes fragile, it becomes reactive rather than adaptive, volatility increases, policy tools lose effectiveness. Every problem requires more intervention, more stimulus, more artificial support. To navigate this kind of environment, you cannot rely on the playbook of the past. The rules have changed. Traditional safe havens may no longer protect you. Bonds that once provided balance now offer limited defense. Cash, once a neutral position, steadily loses value. The key is to think in terms of real returns. What matters is not how much your portfolio grows on paper, but whether it keeps pace with the cost of living and the erosion of monetary value. Diversification is critical. Exposure to inflation-resilient assets becomes essential. You need to look at what cannot be printed, what is grounded in real utility or scarcity. You need to spread risk across countries, currencies, and asset classes. The challenge is not just protecting against downside, but staying ahead of a system where the underlying units of measure are themselves unstable. This environment demands clarity. It demands awareness of how policy, markets, and behavior are interconnected. And it demands action. If you do not adjust, the consequences will not be immediate, but they will be compounding. That is how low interest rates work. Quietly, gradually, until the damage is already done. The key is to diversify not just by category, but by behavior. You need to hold assets that respond differently to the same set of conditions. For example, equities typically do well during growth and low inflation. Bonds perform better when growth slows and inflation falls. Commodities can thrive during inflationary periods. Real estate often moves with interest rates. but can also protect against inflation depending on the structure. Then there are inflation-linked bonds, alternative strategies, and even cash, which plays a role in terms of liquidity and optionality. Think of it like building a strong bridge. You don't want all the weight resting on one support beam. If that beam fails, the whole thing collapses. But if you distribute the weight across multiple supports, the structure is resilient. Even if one component is under stress, others pick up the slack. This is how good portfolios work. Currency diversification also plays a role. If all your assets are priced in one currency, your entire net worth is exposed to that currency's purchasing power. If that currency is devalued, your wealth erodes. But by holding assets denominated in different currencies, you reduce that risk. Again, it's about not betting everything on one outcome. Most investors are not truly diversified. They may hold hundreds of stocks, but if all of those stocks are exposed to the same economic risks, they are not diversified. They are concentrated in disguise. During major market drawdowns, you often see correlations go to one. Everything drops together because the holdings were all sensitive to the same underlying factor. That is the illusion of diversification. True diversification requires growing beyond borders. Different countries operate under different monetary and fiscal systems. They experience different business cycles. They react differently to global shocks. Having exposure across geographies means you are not dependent on the success or failure of any single nation. This is critical, especially in times when global power dynamics are shifting and some regions may face prolonged stagnation while others rise. When you blend these together thoughtfully, the overall risk of the portfolio declines without necessarily sacrificing return. That is the power of diversification. It allows you to achieve a better risk-adjusted return. In simple terms, gives you more for less. And in an uncertain world, that edge makes a profound difference over time. There is also a psychological benefit. A well-diversified portfolio reduces the emotional volatility of investing. When one part is falling, another part is rising or stable. That balance keeps you more grounded, more rational. It prevents panic. It allows you to stay the course during difficult periods. And over time, that consistency compounds. The most successful investors in history did not achieve their results by making one big bet. They did it by balancing risks, by knowing what they could not predict, and by preparing for multiple outcomes. That is what diversification enables. Every so often, the world shifts in ways that are deeper than most people realize while they're happening. These are not ordinary economic cycles. They are paradigm shifts. They happen when the forces that drove prosperity, wealth creation, and policy effectiveness in the past stop working and new dynamics take their place. Most people don't see them until they are already deep into the transition. That's when the rules change. In a world that is increasingly complex, interconnected, and prone to rapid change, the need for true diversification has never been greater. It is not just a defensive strategy. It is a foundational principle of long-term success. It is how you protect what you have while still positioning yourself to grow. It is not an optional tactic. It is a core requirement of intelligent investing. If you study history, you see this pattern play out repeatedly. After major wars, after financial crises, after long periods of debt accumulation or political division, these are the moments when traditional tools break down. Interest rate cuts no longer stimulate growth. Money printing stops generating real productivity. Societies become polarized, trust erodes, people start to question the system itself. And when those things align, a new paradigm emerges. Right now, we are living through one of those moments. The old model was built on decades of falling interest rates, globalization, cheap labor, and relatively stable geopolitics. That world produced strong returns for financial assets and allowed central banks to step in whenever there was trouble. But the tools that worked in that environment are losing their power. Debt levels are now so high that cutting rates further does not create the same boost. Printing money leads to inflation rather than growth. Globalization is retreating as countries become more protectionist and competitive, and the geopolitical order is fragmenting. This is not about doom. It is about adaptation. Those who understand how the environment is changing are better positioned to navigate it, but you must be willing to let go of past assumptions. You must see things clearly. Holding on to outdated models can be more dangerous than not having a model at all. One of the most important shifts happening now is the growing coordination between fiscal and monetary policy. In the past, central banks acted independently. They used interest rates and liquidity tools to manage the business cycle. Governments focus on taxes and spending. But now those lines are blurring. Central banks are funding government deficits, directly or indirectly. Money is being created to finance spending programs. That dynamic changes how inflation behaves, how assets are priced, and how capital is distributed. In these changing paradigms, inequality tends to rise. That is not new. It happens almost every time there is a transition of this scale. The gap between those who understand the system and those who are subject to it widens. Asset owners benefit from monetary expansion. Wage earners do not keep pace. That imbalance fuels resentment. It creates political instability. It leads to more extreme policy choices, and eventually it forces a restructuring of the system. We are also seeing a transformation in the role of money itself. Digital currencies, alternative stores of value, and rising concern about the debasement of fiat currency are reshaping how people think about wealth. The trust that underpins paper money is weakening in many places. When that trust erodes, people start seeking alternatives. Sometimes those are real assets. Sometimes they are new technologies. Sometimes they are simply different jurisdictions. But the direction is clear. The traditional definition of money is under pressure. To succeed, you need to think in terms of cause and effect. You need to understand the drivers behind the numbers, not just the numbers themselves. You need to be global in your perspective and diversified in your exposure. You need to be humble enough to admit what you don't know and curious enough to keep learning. For investors, the implications are profound. You can no longer rely on what worked in the past. You have to look at the environment as it is, not as you wish it to be. Bonds may not provide the same diversification or income. Equities may be driven more by policy than by profits. Currency risk is more important than ever. Inflation is not temporary noise. It is a sign that the paradigm has shifted. And in a new paradigm, the old tools can do more harm than good if used blindly. Most importantly, you need to be prepared to pivot. Paradigm shifts don't happen all at once. They unfold over time. But once they begin, they gather momentum. Those who resist them often find themselves on the wrong side of history. Those who recognize them early have the chance to build lasting advantage. What is required now is clarity. Not in the sense of knowing the exact future, but in the sense of seeing the forces that are at play. The ability to adapt is now more valuable than the ability to predict, because the world is not returning to what it was. It is becoming something new, and those who align with that reality will shape the next era. Strategic asset allocation is not just about picking investments. It is about constructing a system that can endure across time. Most people think in terms of returns, trying to chase what is performing best in the moment. That approach might work in the short run, but it rarely holds up over decades. What really matters is balance. the ability to navigate across all types of economic conditions without getting wiped out when the cycle turns. That is the essence of strategic asset allocation. To understand asset allocation properly, you need to start with the recognition that all assets do well in some environments and poorly in others. Equities thrive when growth is strong and inflation is low. Bonds tend to do well when growth slows and inflation declines. Commodities perform best when inflation is rising. Cash protects you when nothing else is working but loses value during inflationary periods. Each asset class is essentially a bet on a particular set of conditions. Since no one knows exactly what the future holds, the only logical approach is to build a portfolio that is not dependent on one single future playing out. That is where strategic asset allocation comes in. It is the art and science of blending asset classes in such a way that you are not overly exposed to one set of risks while remaining positioned to benefit across a variety of outcomes. The mistake most investors make is confusing diversification with asset allocation. Buying a handful of different stocks is not diversification if they all rise and fall together. Owning stocks and bonds is not sufficient if both are sensitive to the same drivers. Real diversification comes when you hold assets that have different correlations, different return drivers, and different sensitivities to economic conditions. That way, one part of the portfolio struggles, another can carry the weight. In strategic allocation, everything begins with understanding the economic machine. Every economy cycles through four primary conditions: rising growth, rising inflation, and falling inflation. These four conditions create the environments in which asset classes either rise or fall. If your portfolio is exposed to only one or two of those conditions, you are essentially betting that the future will continue to look like the recent past. That is a dangerous bet. When you approach investing this way, you shift from reacting to markets to engineering your exposure. You are no longer trying to outguess the next move. You are building a system that works through uncertainty. It gives you the confidence to stay invested even when the environment becomes volatile. It reduces the emotional swings that cause so many investors to buy high and sell low. Instead, the goal is to build a portfolio that can do reasonably well in all four environments. This is what I refer to as an all-weather approach. It is not about maximizing return. It is about maximizing return relative to risk. More importantly, it is about preserving the ability to compound over long periods without large drawdowns that take years to recover from. The process of strategic asset allocation also forces discipline. It makes you define your goals, your time horizon, your tolerance for risk, and your assumptions about the future. It requires that you step back from the noise and look at the big picture. Most importantly, it helps you avoid overconfidence, which is one of the most dangerous traits in investing.
No one can predict exactly when a regime will shift or a crisis will hit, but history shows that these shifts always come. Whether it is inflation re-emerging, interest rates rising after decades of decline, geopolitical instability disrupting supply chains, or technological innovation displacing traditional industries, the world is in constant transition. A sound strategic allocation does not depend on being right about the next change. It is built to endure across many changes. The real value of strategic allocation reveals itself during stress. When markets panic and volatility surges, most investors are forced to make decisions under pressure. That is when emotion overrides logic. A well-constructed portfolio, grounded in strategic allocation, does not require dramatic changes in those moments. It is already prepared. It absorbs the shock. It preserves capital. It allows the investor to remain calm and focused. Over time, the compounding effect of that discipline becomes significant. Avoiding large losses and staying invested through cycles is what builds lasting wealth. Strategic asset allocation is not exciting in the moment. It does not deliver the thrill of chasing hot trades, but it provides something far more valuable. It provides stability, clarity, and resilience in an unpredictable world. In the end, investing is not about perfection. It is about preparation. The most important decisions are made not in the heat of the moment, but in advance, with a clear understanding of how the system works and how you are positioned within it. Strategic asset allocation is the framework that makes that possible. It is not just a financial tool. It is a philosophy, a mindset, a way of thinking that aligns with the realities of risk, uncertainty, and time. In conclusion, while cash has historically served as a cornerstone of financial security, the current economic realities compel us to reassess its role. By embracing diversification and strategic asset allocation, we not only safeguard our wealth, but also position ourselves to thrive in an ever-evolving economic environment. Thank you.